Hey, what's up, everybody? My best performing video on my YouTube channel was the video that I made that is called How the Loans Inside of an IUL Actually Work. Made that video about 2 years ago, and honestly, I don't know how that video has almost 20,000 views. It's a pretty poor quality video, although it does have some pretty good info. The actual quality of the video was pretty poor. I was pretty new to YouTube at that point. I feel like I'm a little bit better at YouTube and editing and stuff now, so I wanted to recreate the video with a new 2023 version. So let's just jump right into this illustration, and let me go ahead and just kind of show you guys how the loans in an IUL work, looking inside of a policy instead of just me writing some boxes and some arrows on a whiteboard. So here I just picked Massachusetts just because it's a random state. Put YouTube example, male, 35, preferred non-tobacco. Now let's move to the actual face amount and premium here. So I specifically structure high cash value IULs, or in other words, a minimum non-MEC IUL. The reason why we do this is because there obviously are fees associated with an IUL. Those fees being the cost of insurance and other fees, right? So the biggest fee is really that cost of insurance. And so if your death benefit is higher than what it needs to be, then you are going to have fees eating away at the interest that could be getting credited into your cash value. So I specifically structure IULs for people who want an IUL for cash value accumulation. If you want just permanent life insurance, then we can definitely do that too. But if you look here, I'm going to select minimum non-MEC, and I always do optimal switch just because basically the computer in the software that Nationwide uses, in this case, they look at what the cost would be compared to increasing in level, and it actually switches from increasing to level depending on what's going to be most beneficial for you, the client. So here I'm just going to do a 35-year-old who can do $1,000 a month, which is very doable. I have many clients who do that. And then I'm just going to show that they're going to be making contributions until age 65 for this example here. They're going to be doing $1,000 monthly. I won't show any lump sum just because there's really no reason in terms of like the loans and stuff. And then again, I'm going to select the index strategy that I always select, and then I will also include the annual cost summary. And then we'll just calculate this and give this a second to load. All right, now that this is all loaded up here, I'm going to go ahead and go to the actual projection of growth with this policy. All right, so let me explain something to you guys just so that this is as easy as possible for you. This accumulated value, this is what you are earning interest on, and this is what you would be able to take out in the form of like a withdrawal. This net surrender value here, this is what you would be able to take out in the form of a loan. Think of this column as your line of credit with your insurance company, for example, right? So every year, obviously, your line of credit goes up for really three reasons. One, they have a little bit more trust in you. The life insurance company does. There's a little bit less risk just because they can see that you've been paying into your policy. The second reason is because obviously you're putting more money into your policy, so that's why your line of credit's getting larger, because it's following suit behind the accumulated value. The third reason is just because of the compound interest that's also getting accredited into your cash value. That's going to help with how much you're actually able to take out in the form of a loan. And so to really break this down and like explain this to you, just so you guys can kind of see what I'm kind of seeing. If you've never seen an illustration, there's a lot of numbers here, so this might look a little intimidating or a little confusing. But let's just say you have had the policy for a solid 10 years, and you want to go ahead and utilize the infinite banking concept and take a loan from your policy. So you can see here you have an accumulated value of $136,429, and you've paid in 120 grand. So the 120 grand is what you've paid in, 100, and then the difference between 120 and 136 is what you have been paid in interest. So, but you're not going to borrow from this because we don't want to. Because if you borrow from here, then that money is actually gone. It's the same thing as just taking a withdrawal out of your savings account, right? We want you to continue to keep earning interest even though you're using the money somewhere else. How is it possible? How do you do that? Well, what you do is you actually take from the net surrender value column, and you're able to take out $135,841 in the form of a loan. This loan is coming from the insurance company, and they know you're good for the money because A, they're collateralizing your accumulated value, and they know that, you know, at some point in your life it is guaranteed that you will pass away. So it's also a guarantee that your death benefit will pay out. So whenever I say like you don't have to pay these loans back, that's because if you go your whole life and you don't pay these loans back and you have an outstanding loan when you pass away, this death benefit will cover it. So what you want to do is you would want to take out a loan from your IUL versus a withdrawal, because this is what's going to happen. You're going to be able to use this $135,000 and put it into an income producing asset, buy a car. You can do whatever the hell you want with it. Let's just say, because I like to use this example because it makes the most sense, like you're going to buy a car wash, right? I actually have a client who uses his IUL to buy car washes. He rinses and repeats this process. So that's why I like to use this example, because it's the most relevant to me, because I have a client who does this all the time. So my client is going to take out a $135,000 loan because he wants to go buy a car wash. Now, I never knew this before I started working with this guy, but the car wash, you know, makes about 40 grand a month. That's pretty much what all car washes make. The automatic ones that you just kind of go through, they make about 40 grand a month. And so he'll take out a loan for $135,000 from his IUL. Then what he'll do is, because he took the loan, his 136 is still sitting here earning interest as if he never touched the money, which technically he never touched his money. He touched the life insurance carrier's money, which is the coolest part. So while his money is sitting in here earning interest, he took this money out and went and put that into his car wash. Now his car wash is going to produce about $40,000 a month, every month, to pay back this loan and to obviously put some money in his pocket. Now, once he pays back this full loan value, then what he'll do is, let's just say the following year, he pays back the loan. Now he has access to $155,000. So the following year, he takes out a loan, again, for $155,000 to do the exact same thing. To literally rinse and repeat this process over and over and over again until he has like 50 car washes, and he's making an absolute crazy cash flow dollar per month. And the reason why the infinite banking concept is so powerful is because there's no other vehicle in which you can put money into that's going to earn interest tax-free with zero market risk. Not only are you earning interest tax-free, but you can take the money out tax-free and penalty-free, which is amazing. The other part, too, is you never have to worry about, you know, losing this money due to the stock market's poor performance, which is another super cool thing to think about as well. And there's no other vehicle on this planet where you can earn uninterrupted compound interest, where your money doesn't stop earning interest. It never gets interrupted. So you can't just do this with just car washes, right? You have to, you know, understand that there's other people who do this too, right? So I have clients who do this with fix and flips, with people who do buy and holds, with people who buy not just car washes, they buy franchises like McDonald's, or they buy small businesses, or they buy laundromats. So It truly is a powerful tool to use. You also have to make sure that the IUL that you're looking into has alternative loans. Now, I might sound biased here just because it's me in my video, but the IUL that I structure, I can say hands down, is one of the best performing, if not the best performing IUL that's out there. And it does have alternative loans. Nationwide, obviously an extremely reputable business. And so I like to do a lot of my business with them. And so if you are in the market of an IUL, if you want me to run an illustration for you, if you have specific questions, there will be a link in the bottom of this video in the description. Feel free to click that link. That link is just to hop on a Zoom with me. You won't talk to anybody else, right? You will talk directly to me. We'll sit down, and I would love to mock up an illustration for you and see what we can do for you. And if you guys liked this video, please make sure to like and subscribe. If you have somebody else, if you have business partners, if you have a spouse, if you have friends or colleagues or other people who you think that this might be useful for, please share this video. Share my channel to them so that they can do some research, they can do some due diligence on the IUL, see if it will help their financial situation, see if it'll help them achieve their financial goals smarter, faster, and quicker and better. And until then, guys, I will see you in the next video, or I will see you on Zoom. And again, thank you for watching.